听见资本本期视频为您带来的是摩根大通在4月10日录制的关于美国利率市场的内容，主题为基差交易中没有眼泪。这周美国国债市场经历了历史性的大动荡，30年期国债收益率飙升了约60个基点。这背后到底是什么力量在驱动？仅仅是经济基本面吗？恐怕没那么简单。专家们深入剖析发现，这次抛售很大程度上与突发的关税声明有关，这甚至引发了对美元长期地位和美国制度信誉的深层担忧。一个重要的警告是，市场可能正在经历结构性转变，未来可能需要更高的期限溢价，意味着借贷成本面临长期上升的风险。同时，市场流动性急剧萎缩，放大了波动。这是否是系统性风险的前兆？美联储会被迫干预吗？虽然一些关键的市场功能指标还算稳定，比如备受关注的国债现货、期货基差交易表现稳健，但互换利差市场却出现了剧烈波动和大规模平仓的迹象。这又暗示了什么潜在风险？融资市场虽然暂时稳定，但也并非全无压力，特别是定期回购利率出现了一些上行迹象，需要保持警惕。而最新的 CPI 通胀数据看似疲软，但别高兴太早，即将到来的关税可能很快会推高通胀，让前景更加复杂。这期内容将带你深入了解这场市场风暴的核心驱动因素、隐藏的风险以及对你投资组合的潜在影响。接下来是英文全部内容，如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
Welcome to At Any Rate, JP Morgan's Global Research Podcast. I'm your host, Phoebe White, Senior Rate Strategist and Head of U.S. Inflation Strategy. And today I'm joined by Jay Barry, Head of Global Rate Strategy, Srini Ramaswamy, Head of Global Rates Derivative Strategy, and Ipek Ozil, Head of U.S. Rates Derivative Strategy. So it's been a historic week in Treasury markets. We saw 30-year yields rise roughly 60 basis points between last Friday morning and the overnight highs on Wednesday, even as risk assets were falling. And with all that volatility, our team fielded a barrage of questions about the source of the selling pressures, and our comments today are based on our recent publication on the topic, which is available to institutional clients of JP Morgan on JP Morgan Markets. So Jay, let's just start off with fundamentals here. Through the first half of the week, as the Treasury market was selling off aggressively, market-implied Fed and long-run inflation expectations were actually pretty stable. So are there any fundamental factors you can point to that contributed to the sell-off, and how are you looking at Treasury valuations now at these levels?
Yeah, thanks, Phoebe. I think at its root, this sell-off, I think, really began after the president's Rose Garden announcement last Wednesday. And as you mentioned, the market's Fed policy and inflation expectations were a little changed over the period. So it's funny that from where we were late last week to where we were yesterday or even today, 10-year yields on our valuation metric had gone from looking very close to fairly valued in the latter part of last week to trading as cheap as 40 basis points cheap to fair value over that period. So one could argue there was something a little bit fundamental in the move, but that the bulk of this move is unexplained by kind of what we can see in our models. But if I think about it, I think the fundamental driver was the tariff announcement. And with this blanket approach, does it raise the risk that the U.S.'s status as the reserve currency might be changing over the longer term because of questions over institutional credibility here in the United States and the approach to the trade war? And it's very interesting in that regard that yields only reversed lower yesterday once the president announced that there was this 90-day delay on any country that was not announcing reciprocal tariffs. And the way we can say this, of course, is through, I think, what we see with the discrepancy and the divergence from fair value in our fair value framework, but also that traditional measures of term premium rose throughout. And I think this is something that we've been thinking about on our team, as you know, for the last couple of years, which is that the Treasury market is going through kind of a tectonic shift for demand right now. So the Treasury market continues to grow at a pace of about 6% per annum, which is pretty aggressive considering where the economy stands right now. And at the same time, demand is transitioning away from the Fed, from U.S. banks, and from foreign investors. And that transition towards more price-sensitive demand, we've argued, means more term premium over time and higher term premium. And in fact, when we examine more academic measures of term premium, we find that the Fed's balance sheet as a share of GDP matters and FX reserves as a share of GDP matters. So there was a tailwind from excess savings globally being deposited into the US at the beginning of this century through the growth of foreign exchange reserves and the dollar's large share of those reserves. And as that's been coming down, I think it's been moving in the opposite direction. So I think the announcement last week really brought to the forefront, and this is something we took a look at in our daily piece earlier this week, what does this mean for foreign demand for treasuries? And it's very possible it means reduced foreign demand over time. And if that's the case, higher term premiums, and we really map term premium through to the slope of the yield curve. So this bearish steepening of the yield curve, to me, alongside what we see in our valuation framework, indicates that it was a sharp injection of term premium. To be fair, as we wrote about in our piece last week, or earlier this week, I should say, we don't think it's likely that there was aggressive foreign selling. And strictly speaking, because if we look at what the ownership sort of contours of the treasury market look like for foreign official investors, about 30% of what they own is 0 to 2 year maturity. About 65% of what they own is 0 to 5 years. So they could just choose to let these assets roll off. Nonetheless, I think this is where the other technical comes in, and that prior to this week, and really for the better part of the last couple of months or so, our Treasury client survey has been indicating that the breadth of the longs in those overweights is as high as we've seen really over the last 15 years. So I think clients who were overweight duration on fears over weakening growth and a Fed that may have to act in response were moving to the sidelines, saying perhaps we need to be cognizant of this shift in sort of potential demand and the need for higher term premium over time. So that's left us where we are. But it's also meant that as the president did sort of push back on this tariff announcement from last week over the last 24 to 36 hours or so, that's also what's helped rates come off their absolute highs. And you mentioned that, 10-year yields have traded a 60 basis point range, and we're about 15 basis points off the highs as we speak before the bond auction this afternoon. And I also think that, as we move forward, part of this exaggeration of the move has been driven by liquidity conditions as well, because we look at total treasury market depth, duration weighted across the curve at the most liquid point in the US day, it's declined in excess of 60% week over week. And we think that's sort of exaggerating these moves as well. So in that context, even though we look quite cheap relative to our valuation framework, it's not as cheap as we've looked multiple times over the past 2 to 3 years. And while the announcement yesterday was certainly helpful for reducing fears over the trade war for the time being, it doesn't seem like it's completely over. Thus, it would seem that the risk could be we could revisit those cheapest levels that we've seen being about 50 basis points divergent from fair value. And I think that's one of the reasons why we're more cautious on longer duration assets, and why we've been thinking that it's likely that if the Fed does begin easing later this year, it'll really be the front end of the curve that's more likely to participate than the long end of the curve. So Phoebe, if I can turn it back to you, I was just mentioning how market depth had fallen to pretty depressed levels. I think one of the big questions that we've been getting this week, and that we tried to answer in our piece last night, is this a sort of move in liquidity conditions that would force the Fed to come in and intervene? So I know we've got a full suite of liquidity metrics that we watch. What else do you see in the Treasury market right now with respect to liquidity and functioning? And what do you think it means right now?
Right. So just starting with market depth, I think it's certainly fair to say that a decline in liquidity contributed to the volatility this week. You mentioned it was a very sharp decline in market depth. Just for context, on a duration weighted basis across the curve, that fell to around 65 million on Wednesday. For most of the past year, that's been averaging closer to about 250 million. So pretty big drop there. It is the lowest since the collapse of SVB 2 years ago, and close to the levels that were reached in March of 2020. But outside of that pullback in liquidity, other market functioning metrics actually stayed at pretty healthy levels throughout the week. So for example, we actually see little sign that there was selling in less liquid off-the-run securities. That kind of behavior would typically drive higher dispersion in yields along the curve. That would show up as a rise in the RMSE of our par fitted curve, for example. We did see that measure tick up a bit, but it's nowhere near what we saw at the start of COVID. And then lastly, if there was that greater liquidity preference, you would also expect to see a richening of on the runs on an asset swap basis relative to deep off the runs. Again, there was little sign of that happening either. So from that perspective, I think this episode does appear very different from the large scale deleveraging episode that we observed in March of 2020. But I think recognizing this, Srini, let me just turn to you. Clearly, we fielded a lot of questions this week around the Treasury cash futures basis. So to start, can you just remind our listeners briefly what this trade is, why it has grown so large in recent years, and what you can glean from the futures price action this week?
The basis is certainly a very, very popular topic of conversation, and for somewhat good reason. I think over the past several years, call it, 4 to 5 years, something of that order of magnitude, there's been this steady increase in the utilization of futures by asset managers. So you see that in the CFTC data. So net, there's, and there are structural reasons for this, by the way, which is extremely well documented in one of the, reports by the TBAC, the Treasury Borrowing Advisory Committee. But long story short, asset managers tend to have some portion of their exposure to treasuries in the form of treasury futures, which means someone has to supply, or take the other side of that trade, and as a result, speculative investors or hedge funds and leveraged funds of various sorts have been on the other side, so they're structurally short futures, and in that sort of a situation, they tend to hedge, which means they are effectively long the basis, right? So spec funds are short futures because the asset managers demand it, and then they are long cash bonds on the other side. Now, this is all factually true. And the concern always has been that in periods of elevated volatility, you might get sort of big unwinds of the basis trade on the part of these, spec funds, and that will somehow, produce a lot of widening in the basis or narrowing in the base, moves in the basis, etc. It's not an unreasonable concern, but the market action this week has actually been pretty well behaved. And what that tells you, so first and foremost, it's important to remember that the basis is basically the difference between a spot bond price and a forward price for the same, bond, to an approximation that is true. And this is an arbitrageable relationship, and all that arbitrage requires is balance sheet, right? So the fears are really that balance sheet can become scarce, or, repo funding markets can freeze up or something like that, which can cause moves in the basis. What we saw this week is that gross bases are extremely, have been very stable. Bases net of carry have been, very, very stable, really showing no sort of pressure from basis unwinds. So you can sort of extend this question and say, okay, has there been any impact at all in the futures markets? For example, if there has been significant unwind of positions by investors in the futures market, not necessarily basis positions, but just futures positions, well, you would see that in the relative valuation of the CTD bond, the cheapest to deliver bond, relative to other surrounding bonds. And even there, you don't really see it in most sectors. The one exception to that is the classic bond contract, where you can see, some move, some cheapening, in the CTD relative to surrounding bonds. So there's been some impact there, but really in the grand scheme of things, I would say it is remarkable how well behaved Treasury futures bases have been in a extremely volatile time for every other sector of the market. So certainly not a whole lot to see in the basis.
Thanks for that, Srini. Even as the futures basis has been pretty stable here, I think the same cannot be said of swap spreads. So Ipek, let's turn to you. You have highlighted that there are signs of large-scale unwinds going through in the spread space. Can you walk us through what you're seeing there and where this week's moves have left valuations?
Yeah, sure, Phoebe. So I would say the moves in swap spreads in the past week have been nothing but dramatic, right? Like spreads have been narrowing since last Wednesday's announcement of tariffs, with a bounce back higher yesterday afternoon, and then they are narrowing again today. But if you look at the moves, they've kind of been head spinning, really. Just to give some context, usually swap spreads move by about, call it 1 to 3 basis points over the week. But yesterday, intraday, they moved by over 10 basis points. So that's huge. So there's been a lot of volatility in swap spreads. But I think to make sense of the moves, it's helpful for us to take a look at what we call the term structure of swap spreads and how it evolved between, say, last Wednesday to Tuesday, when a lot of the narrowing had happened. And maybe I'll digress quickly for our listeners and say, when we say term structure of swap spreads, what we mean is the slope and intercept from a regression of swap spreads in benchmark tenors versus their modified duration. So when we look at this term structure, we see two things, or I should say, when we look at the evolution of term structure over the week, we see two things. One, there's been a significant downward shift in the entire term structure. And two, further increase in term funding premium has inverted this term structure even further, meaning longer end spreads have narrowed more than front end spreads. So the large downward shift in the term structure is, we think, like a sign of deleveraging. And we've seen this actually play out in prior episodes. So if we were to look at the pandemic era, the UK LDI crisis in 2022, or the regional banking crisis back in 2023. But then question is, how do spreads come back? Like, what makes spreads come back? And I think it's important to recognize that these bouts of deleveraging do not quickly reverse course unless there's some policy response. So, of course, we had QE in 2020, and we had the launch of the BTFP facility in 2023. And the UK LDI crisis was not necessarily US focused, even though it impacted spreads. So there was no policy action then, which is why it took a little longer for spreads to correct. So if we take history as a guide, right, like a policy reversal on tariffs could be the most likely catalyst for retracement. And we kind of saw that on Wednesday when the 90-day pause was announced. So, if the tariff-related developments remain positive in the coming weeks, then there's room for spreads to widen further, as now they look actually very narrow to our fair value estimate. But, as we were saying earlier, it's not obvious that tariff-related headlines will actually calm down and will not whipsaw the market again, which is why we're, I would say, cautious on swap spreads right now.
Okay, so just to sum it up, spreads have really been at the center of this volatility this week, and it's happened without much pressure on balance sheets and hence more stability in the futures markets. Srini, I want to come back to something you said earlier in terms of the potential for basis trades to come back to the forefront if we were to see broader fears of balance sheet seizing up or broader funding pressures. So I just want to touch on funding markets then. Any signs of funding pressures this week? What did we see in repo markets? And is there anything we should be looking out for that could potentially present problems going forward?
Great question. So the answer is some pressure, but really not all that much, is or pretty well contained, maybe the way to describe it. So yes, there has been, repo rates have been, GC repo rates have been volatile, as our short-term strategists have pointed out. But they sort of remain within the Fed's, target band, which is in the grand scheme of things pretty healthy in this sort of environment. The other question you could ask is, what about term repo rates? Is there something there? Term repo rates don't trade all that much, but you could actually look at implied repo rates in the futures market, in the treasury futures markets. That's actually, futures may be the most liquid or highly traded form in which there's some sort of risk exposure to term repo, and the implied repo rates sort of capture that. And if you look at that, yes, there has been an upward move in term repo. If you compare it to sort of, a date-matched OIS rate, right? So given where Fed funds expectations are, term repo has certainly gone a bit higher, call it 20 to 25 basis points higher. But the price impact of that is pretty small. It's about a tick or less in the basis. So I guess the answer is there has been some pressure on, especially term repo rates, a little bit upwards. And that's a thing to watch, but it is not really flashing red, at this point, especially when you compare it to what EPEC talked about and sort of the giant swings in swap spreads, etc. The sort of relatively moderate upward pressure that you see in term repo in the form of implied repo rates, etc., is sort of, I would say, well contained.
Thanks, Srini.
Phoebe, maybe I can step in and ask you one more question right now, because the focus clearly remains on the tariff developments, and it will for some time now. But we also got the March CPI report this morning. What did we learn from that report, and how have inflation markets fared through this week's volatility?
Sure. So we did see actually a pretty weak core CPI reading. It came in just 0.06% on the month. Consensus expectations were for a 0.3 gain. There really was weakness across categories. Core goods prices fell 0.1. That was the weakest since last August. Service prices also came in soft. We saw a huge swing down in supercore that fell 0.24%, driven by big drops in hotels, airfares, and auto insurance. I think it's tough to take too much signal from this low reading in March, knowing that we are likely to see a pretty significant acceleration in inflation here in the second quarter with the implementation of tariffs. In the goods basket, for example, a lot of that weakness did come from used vehicles in March, but we know that's about to change in short order. So I think just taking a step back and looking at inflation markets here, we estimate that the market fixing was priced for a low side 0.2 on core. So we did see 1-year CPI move lower on the back of the report to account for the downside miss. And the forward curve here is really, I think, responding more broadly to the macro moves today. And seeing where we are now on the week, break-evens are slightly higher. The break-even curve is modestly steeper. The long end really has outperformed in all this volatility. 1-year CPI is only modestly higher on the week. From a valuations perspective, intermediate break-evens continue to look about 10 basis points or so cheap versus our fair value framework, which looks at broad commodity prices and the shape of the OIS curve. I think where we go from here in inflation markets is incredibly difficult to say, given the uncertainty on the tariff front. At the very front end, I think 1-year CPI could continue higher if all the tariffs do proceed as they have been announced, and the 10% universal tariff stays in place for now, 125% on China. We also have the 25% auto tariffs. All of these things, I think, point to some very firm CPI readings over the next few months. But that said, if they stay in place, this does suggest downside growth risks. And I think beyond the 1-year point, especially out to the 5-year point or so, remains very susceptible to increased recession fears. I do think that further out on the curve, 5-year should continue to exhibit a bit more stability. But again, the front end of the curve, I think, very sensitive to the tariff news here as we move forward. I think in general, if these tariffs stay in place, we do predict as sort of a baseline forecast here that break-evens can move modestly narrower, but that they should outperform on a beta-weighted basis versus nominal yields.
That's great, Phoebe. Thanks so much. And thanks to Ipek and to Srini as well. And I think let's leave it there for today. But before we go, we just have to say a quick thank you. As some of our listeners are aware, our good friend, colleague, partner, mentor, and teacher, Srini Ramaswamy, will be soon leaving us. And we just want to say thank you for his partnership, his mentorship, and all the great things that he's done for JP Morgan Research over the last 23 years. So Srini, thank you very much.
Thank you so much, Jay. Very kind words. Thank you.
Well, I couldn't be more appropriate. But we'll leave it there. And to all of our listeners, we hope you find this discussion informative. As Phoebe has already said, you can find more in-depth information available in our published research, available on JP Morgan Markets. Stay tuned for more episodes of At Any Rate, JP Morgan's Global Research podcast series. This communication is provided for information purposes only. Please read JP Morgan Research reports related to its contents for more information, including important disclosures. Copyright 2025, JP Morgan Chase & Co. All rights reserved. This episode was recorded on April 10th, 2025.